Hello, we are Tim Craighead and Laurent Douillet, the European equity strategists at Bloomberg Intelligence. We'd like to give you our first impression on year-end earnings that are in the midst of taking place, where about a third of the companies have now reported. So to start things off, Laurent, you're the one who's been doing the heavy digging here into the numbers. What's your overall assessment and what sectors stand out?
So far, I would say that the results are quite positive. We have 59% of companies which have beaten estimates by more than 2%, and the reporting earning growth is 29% versus initial expectation of 27. As we expected, technology, banks, luxury good companies are driving the upside. However, we have two caveats. The first one is healthcare, which is quite disappointing, with more than 60% of companies missing expectation, and earning growth, which is just 6%. And also, second, we have the margin pressure, which has finally started to impact results in several industries.
So how's the market reacted to earnings so far? Are the conference calls and the earnings statements having an impact on stocks?
Not really. I mean, as you know, for the moment, equity markets are impacted by the prospect of tighter monetary policy, not just in the US, now in Europe, given the comments of Christine Lagarde last week. So I would say the company fundamentals have so far a limited impact on the share price reaction. If you look as of last Friday, the average return of the companies beating both sales and EPS estimate is slightly negative at 0.5%, and it is net of the stock 600. And for the companies missing estimates, the punishment is even harder, with an average decline of about 3%.
So we've been watchful on profit margins for a while, given that profitability is at very elevated levels and costs are rising. Are there any signs that profit margins are cracking at this point?
Yes, unfortunately, we are seeing the first sign of margin weakness in sectors like industrials, materials, and consumer staples. For example, 70% of the capital good companies which have reported so far have missed margin expectation. And if you look at the forward guidance of the few companies which dared give a number, the guidance are quite disappointing. Given the ongoing rise in commodity prices and also component shortages, I think this headwind will remain with us for at least the first half of the year.
So one other developing risk factor that's emerging on our radar screen is rising inventories, which could have an impact on cash flows and profitability as we look forward. What do you see in there on this issue?
Yeah, I would say overall it's something which could have been expected because of the supply chain constraint. However, when you look at the overall level of inventories for the companies having reported, it is 18% higher than at the end of 2019. And even if we adjust for the stronger activity, the ratio is still 270 basis points higher than before the pandemic. How concerning it is, I think it really depends sector by sector. But as we still see component shortages in industrials or healthcare equipment, I think here a high level of inventories could be an issue. On the other hand, technology, which is a sector which is often impacted by high level of inventories, so far the increase has been just in line with sales. So the sales to inventory, the inventory to sales ratio is just a reasonable 17%, which should be okay for them.
Well, look, let's leave it there for now. You can find our ongoing analysis of the European earnings season on the Bloomberg terminal at BI Stocks E. That's STOXE. And thanks for your time.